Hi, this is Alan Gassman. It is Thursday, January 24th. It is 12:30 p.m., and we are ready to take you up like a rocket ship to show you the rules from 30,000 feet, 20,000 feet, and 10,000 feet that apply for real estate investors and professionals. Internal Revenue Code Section 199A was passed in December 2017. Proposed regulations mucked it up in August of 2018, and then we got new final regulations, which help a little bit, and a revenue procedure for real estate investors effective last Friday. We've spent a lot of time studying these rules. We don't know everything there is to know about these rules, but we do know a lot. And you can email me at agassman@gassmanpa.com. I'll be checking my emails during the presentation, and we can answer all of your questions, whether during the presentation or thereafter. For your friends and neighbors, we will be doing video replays. Please also note that next Tuesday, this is incorrect here, next Tuesday at 5 p.m., that's the 29th, we will have, a replay of this. Another presentation, 50 minutes for CPAs and tax advisors, which will go into more depth. Also, you see our calendar here, February 7th in St. Petersburg. I'll be speaking on creative planning for Section 199A. And if you happen to be in North Carolina, next month I'll also be there at the UNC tax conference talking about 199A. If you happen to be in the Caribbean, March 14th through the 18th, or on the Pinellas County Medical Association cruise, we'll be talking about 199A there as well. I think everyone on this call knows that under Internal Revenue Code Section 199A, if you have a U.S.-based trade or business, it's an active trade or business in the United States, then your S Corporation K-1 income, your partnership K-1 income, your Schedule C individually owned trade or business income, your net rental income on Schedule E, and your farm income on Schedule F can all qualify for the Section 199A 20% deduction. If you are in the 37% bracket, this will take you down to the 29.6% bracket, which is a very nice thing. Now, on page 7, if you are someone who is single and you have taxable income below $160,000, then most of the rules that we're going to talk about here mean nothing, and you get the deduction. But if your income is above $160,000 if you're single or filing separately, or above $320,000 if you are married filing jointly, if the income is from a specified trade or business, and fortunately real estate is not a specified trade or business, or if your entity does not have sufficient wages or qualified property, then you can't take the deduction. So doctors, lawyers, accountants, and apparently even closing agents, who the IRS regulations say really are very much like accountants, won't get the deduction if they're high earners. And people who own old properties that have already been completely depreciated and are more than 10 years old will not get the deduction unless possibly they pay wages. So that's a very general overview. Brandon or John, correct me if I'm wrong, a real estate broker, a real estate agent, is that a specified trade or business?
No, they are not considered to be specified service trade or business, and actually the final regulations specifically point that out. So if you are a real estate agent or broker, you are exempted from those specified service trade or business rules, and if your income is above the threshold level, you really only have to worry about the amount of wages that you pay or the amount of basis that you have in qualified property.
Beautiful. I'm glad you knew the answer to that because I wasn't sure you did when I asked it. Now, just a little tiny bit of housekeeping. For 2018, the threshold amount was $157,500. Now it's $167,000. You'll want to use these numbers at cocktail parties when you talk to other accountants. They'll think you're really smart. Page 9, Michael Keitz's amazing Section 199A summary. Anyone on this call can receive a free copy of the PDF version of our Section 199A book, which has a chapter that walks you through this chart. That's the introductory chapter. The book is now out of date because it talks about the proposed regulations but not the final regulations. We are working feverishly to put the final regulations into the book, and we will issue anyone who bought the book before not only the new book, but also a redlined version so you can see what the changes were. The changes were not as bad as we had thought about. Now, if you are in the real estate business or you are advising people who are in the real estate business, please don't put real estate in S corporations. Stop it. It's not a good thing to do unless you have a basis adjustment situation, such as you're old or ill and may die soon and you want a stepped-up basis within the entity, or you think that you may end up in bankruptcy or in an insolvency. Otherwise, usually the real estate should be in entities taxed as partnerships, not S corporations. Not everyone agrees with this, but a lot of people do. And there's further detail on this on page 11. You can talk to your debtor-creditor lawyer. If you are in an LLC, taxed as a partnership, or disregarded for income tax purposes, and you end up having the bank take the property back over, you may get taxed very unfairly. So that's when you would want to be a S corporation and a C corporation, which you can't get to from partnership status if there's a lot of debt very easily. Another idea just before we sail into 199A land is protect your real estate assets from creditors. On the bottom middle of this chart, Pillsbury Animals LLC actually owns a leveraged horse farm. It was free and clear when the client came to me. We put it in the LLC, and then we put a note for 85% of its value owed to a Nevada LLC. So if you sue the ranch land company, you're only going to get 15% equity at best. Then we have them net lease that land to a master leasing company owned pretty much by the same family. And your lease, if you have your thoroughbred on this in the stables, is with the master leasing company. And the master leasing company is certainly a trader business. So that's where we want our profits to be. So you get hurt on the property, you sue the master leasing company. Under Florida law, the way we've laid out the lease, you're going to have a really hard time suing the real estate company. So the master leasing company, you may become the owner of some straw and horse poop, because that's mostly what the master leasing company owns, and some stalls. Okay, what we did was we took our 2018 Forbes articles on real estate, and we've put them here redlined. And Brandon and John were kind enough to do this, and will go ahead and lead this discussion.
Okay, so the final regulations did provide some clarification on how to deal with real estate in relation to 199A. For example, it issued a safe harbor that provides some guidance on what sort of real estate activities will qualify for 199A deductions. Also, we have to remember that capital gains will not qualify, so that's important for real estate. When you generate capital gains from a sale of a piece of real estate, that is not going to qualify you for the 199A deduction.
What about depreciation recapture? When you sell a property and you have to recapture the depreciation, are we clear on whether that is can qualify for the deduction?
Yeah, I think that those depreciation recapture that produces ordinary income will be eligible for the deduction. There's some guidance there about under Section 751 hot assets, when they're sold, that the regulations make clear that those assets are eligible for the deduction. So I think the same logic would apply for depreciation recapture of real estate.
Even when it's only at the 25% bracket, I guess. We're not 100% sure on that, but we're hopeful for it.
Another thing to consider with real estate is your income. If you have net investment income tax liability or an employment tax liability, you're not going to be able to use the 199A deduction to reduce those taxes. And on the next slide, we see that the deduction does not apply for an employee. So there may be an incentive for some people to try to switch over to be an independent contractor. However, the rules do provide that when you switch over from an employee to an independent contractor, you will be considered, there'll be a presumption that you're still an employee for 3 years after. That is just a presumption, so you can rebut that presumption and prove that you are an independent contractor and take advantage of the 199A deduction.
So in other words, if you are a landscaper, or you are a construction worker, or you are a realtor and you've been paid as an employee, you can't take the deduction, but you could renegotiate your arrangement to become an independent contractor. Right. And the proposed regulations said that it would be very, very difficult to not be considered an employee if you are doing the same physical and mental labor. The final regulations make it much easier. Final regulations say that if you can really make sure that you would be an independent contractor, and if you make meaningful changes in the economic arrangement, they will recognize that you are no longer an employee. In addition, the presumption that we were worried about only applies for 3 years.
Right.
So the 4th year, you no longer have the presumption counting against you.
Yeah, so one of the main benefits that came out of the final regulations was they released this new proposed revenue procedure regarding a safe harbor for real estate activities to be considered an active trader business. To be eligible for the deduction under Section 199A, you have to be considered an active trader business, and there was a lot of question as to whether triple net leases would meet this requirement and how the real estate industry would satisfy this requirement. So they did provide us with guidance, and we'll touch on that in slides that are coming up. Now, there is one important exception that the proposed regulations did give us, and that was retained in the final regulations. And it says basically if you have a passive lease, whether it's triple net or not, and it's rented to an active trader business that you commonly own, then that's automatically going to be considered an eligible trader business and thus eligible for the Section 199A deduction.
So if I have a building that I lease to my law practice, that's going to be considered an active trader business, and if I am fortunate enough to make less than $320,000 a year in taxable income with my spouse, then I can write off the 20% against my rent income,
right,
and against my law income.
Exactly.
Even though it's a triple net lease.
Right.
And would that apply if I had a triple net lease to somebody else's business?
It would not apply because you have to have 50% common ownership with the entity that's renting the building and the entity that is the active trader business. So if you rented it to an unrelated party, triple net, that by itself is not going to amount to an active trader business and not be eligible for the deduction.
What if I rent the property to a C corporation that cannot take the 199A deduction, but I own and operate the C corporation?
So I think that would qualify because you are renting it to an entity that is commonly controlled. As long as you own that C corporation more than 50%, it looks like under the final regs that you can qualify as an active rental, even though the building is held in an LLC and is a more passive triple net type arrangement.
Okay, so those of you who are not tax lawyers or CPAs, there's something very important derived from what Brandon said. Don't try this at home. No matter what we say on this webinar, there could be an exception. But if you have a triple net lease, you're going to probably want to renegotiate it so that the landlord does more than just collect the rent, because unless this triple net lease is to a related party that is an active trade or business. That's pretty much what the rule is here. And by the way, we are working on a Forbes article that will be posted this week analogizing the IRS to Marquis de Sade concerning these triple net lease arrangements, because we know a lot of clients who have triple net leases where they're at financial risk. They have to work hard to verify what's going on. They have to renegotiate with tenants, monitor tenants, make them fix things that should have been fixed. And that's just as active as running a convenience store or a brothel or, other types of businesses. Why the IRS assaulted triple net leases, I don't know. Maybe somebody who wrote the regulations had a bad experience as a tenant. Who knows? So, you want to talk about the safe harbor, Brandon?
Sure. So with the safe harbor, just because a triple net lease does not fall under the safe harbor, it doesn't mean that somebody dealing with triple net leases is not going to be eligible for the deduction. They just have to meet the standards of Section 162 as an active trade or business to qualify. So you have to look at every single situation with its specific facts, and you could always go to case law to try to determine if there is a possibility for your specific facts to qualify as an active trade or business.
But this proposed safe harbor under Notice 2019-7 says that if you don't have a triple net lease, you can be considered an active trade or business if you follow these rules. Number one, separate books and records maintained to reflect the income expenses of each enterprise. So we recommend separate books and records for each separate building, so you know what you're doing anyway. Number two, this is the hard part, contemporaneous records created to include time reports, logs, or similar documents describing all of the services performed and the dates when they're performed by everyone who performed them, and 250 hours of total time. So if I have 5 rental homes, the time of the person who goes out and sprays for insects, the time of the repair people, the time of the landscaper, the lawn person, my time going out to the house and talking to the tenant, the time collecting rent, if that's 250 hours, then I am considered to be an active trade or business of real estate. If it's less than 250 hours, then you go to what John was talking about, which was the facts and circumstances test, and good luck. I have to say it concerns me that this discriminates against somebody who only has 1 or 2 rental houses versus somebody who has 30 rental houses. And I'm not sure why they chose to do that, but they did. So these services include what you see here on page 21. You can count the time for these things, and on page 22. And it averages out to about 4.8 hours a week. On the other hand, there's certain things that rental services exclude, and we can send you that list if you like, or you will find it if you just Google IRS Notice 2019-7. By the way, keep your eyes open because the notice indicated that it will be reissued once the IRS receives comments. What do we have next?
Yeah, so the next slide talks a little bit more about whether or not you can qualify for the safe harbor, what triple net leases. It talks about how triple net leases do not qualify under the safe harbor. And then we get into a little bit of this discussion about being a specified service trade or business. And if you crack off your rental property and try to actually take a deduction attributable to the income earned for the rental income as not a specified service trade or business. And what the final regulations tell us is that's not going to work, assuming that the rental entity is commonly owned. And we have a chart here that shows how this works. On the far left-hand side, if the entity that's renting the property back to the specified service business, or maybe providing some sort of management services to the specified service trade or business, if it's less than 50% commonly owned, so you have 51% or more ownership by unrelated parties, then that will be eligible for the Section 199A deduction. So you can see green there. That's good.
Okay, so let me just stop here. in red, the specified trader business would be a legal firm, an accounting firm, an actuary firm, one of the company consulting firm, and they're nailed. They're not allowed to write off the income, the 20% write off if they are high earners. So they have a building that they lease to this specified trader business. It's an active lease. They spend more than 250 hours doing it, but the sole tenant is the related party specified trader business. Sorry, Charlie, no deduction. On the other hand, if the landlord entity leases half of the property to the related party specified trader business and the other half of the property to another business, another tenant, whether they are a specified trader business or not, then they'll get half of the Section 199A deduction, or at least the deduction based upon the proportion of net income coming from that other tenant. But on the left-hand side, if you own 49% of the building as a related party and 51% is owned by your significant other who you are not married to, or your cousin, but not your sibling, or your best friend from college, then your share of the income, Brandon, is or is not 199A.
It will be eligible for the deduction.
It will be eligible for the deduction. So you go ahead and buy half a building, buy 49% of a building, leased to two businesses, one is yours and one is somebody else, and you're okay. And you can make your best friend from college or a trust for your children maybe a tiebreaker, and it talks in terms of percentage of ownership, not voting rights. So you could still control it. You might even be able to do some sort of a special allocation, although the regulations don't want you to. Anything else on this slide 24, which you did a great job designing and building, Brandon?
I think you've covered it, Alan. If you flip to the next one there, we just have a common example of when a rental activity would be considered to be an SSTB and not eligible for the deduction. Here where you have the building in a separate entity, even if it's 100% owned by the same person that is owning the SSTB, then you're not eligible for the Section 199A deduction unless your income is below the thresholds.
Okay. It's as easy as that.
Right.
All right. What do we have here on page 26? And
here's just an example of a way to potentially get around these rules. Like we talked about, if you have less than 50% common ownership in the real estate entity that holds the building that's renting it back to an SSTB, then it doesn't matter. That the building income will be considered non-SSTB income. So if you have three doctors that each have their own separate practice, they get together, put their real estate under an entity that's owned equally by the three of them, and then that real estate entity rents out the buildings to the three doctors' separate practices, then that will be eligible for the Section 199A deduction. So if you can avoid that 50% common ownership rule, then this is a good way to break off some SSTB income and shift it over to an entity that is eligible for the 199A deduction.
Oh, that's very good. So what do we have here on page 29? This is very interesting.
Yeah, so like we talked about, if you do have common ownership, the real estate entity is going to be considered an SSTB and not eligible for the deduction if you're over the threshold. But another way to get around that is to have the ownership of the entity that's renting the building back to the medical practice or other SSTB entity held by taxpayers in a lower tax bracket. So that could be your children or your spouse, or that maybe files separately on a return, or your brother or another relative. And another idea here is if you don't want to give them ownership outright, you can actually place the ownership in a trust that is considered to be owned by the beneficiary of the trust and all the income reported on the beneficiary's tax return. So even though they may not be able to get distributions and you can control when those distributions come out, they're going to be taxed upon the income. And if their income is below the threshold level, then you can take the Section 199A deduction on that type of arrangement.
Okay, so even though a trust for my daughter counts as far as the ownership 50% test, the fact that my daughter doesn't make $150,000 a year and that this trust can be considered as owned by her allows the write-off to take place. And this trust, this Section 678 trust, can actually be used for my spouse and for my other children and for my synagogue or church, yet the income tax bracket will be lower, even though my daughter doesn't receive any assets from the trust, right?
Right.
So these 678 trusts are very, very useful. Now, page 30, we simply point out for those of you who are tax lawyers and CPAs, you're aware of the use of things like a sale to an irrevocable trust or a grant or retained annuity trust. You can do the same thing, and in fact, we have a couple of these going here at the office now, where we have valued the real estate, replacing a percentage of it that stays taxed to the client under a grant or retained annuity trust, so we'll save estate and gift tax, while other portions pass to the Section 678 trusts. So it's possible to do a lot of planning. We've got some information here on the 678 rules. If you Google Gassman Forbes 678, you'll find our article there. And by the way, on page 34, we have the factors that you would use to determine whether someone is treated as an independent contractor or as an employee. As a practical matter, if a landscaper or a repair person wants to become an independent contractor, they'll normally set up an S corporation, but then they have to take some salary that does not qualify for the 199A deduction. So they may be better served actually using a disregarded LLC or owning it personally as a proprietor and having it on their Schedule C. They will pay more employment taxes, but they will pay less income tax because of 199A, and you have to run the numbers on that. And Vince Lackner, who has software that will help you run that numbers, is on the call, and he'll be glad to share that with you if anyone's interested. He's got some very impressive software, and he's a very, very smart, impressive guy. So there's a lot of expertise in this area. Your CPA needs to have software. It would take a long time to spreadsheet this. Okay, with 3 minutes left, we're 65% through the talk. We're going to go through now the second Forbes article that we wrote, Don't Let Your Deductions Fly Out the Window. And we should not take too long here to be able to cover this for you, Brandon.
Yeah, let's flip forward to slide 41 and talk a little bit about aggregation of different types of entities. So if you're over those thresholds, you're going to be subject to the wage and qualified property test, where your deduction is limited to either 50% of the wages you pay or 2.5% of your unadjusted basis in qualified property. And what that means is basically the original cost that you acquired that property can be used for the life that you would depreciate it, which is generally 39 years for real estate. So if you have different properties that are rented out and you're worried about whether one property would meet the test or whether this property is going to meet, or if I have enough basis here or there, you can actually make an election to aggregate all of those different activities together for purposes of determining whether you'll satisfy that wage and property test. Now, there are some requirements that have to be met, and those are listed here on this slide. One thing that the final regulations did point out, which is a little strange, I thought, is that residential rental properties and commercial properties have to be kept separate and cannot be aggregated. So apparently they are not considered as products or services that are customarily offered together, even though they're basically the same type of rental, just a different type of tenant. So that's something to keep in mind when you are aggregating. Another thing is that this aggregation election is considered to be permanent. So once you aggregate entities together for one tax year, you can't do something different in a later tax year. Now, if you do acquire new property, you can elect whether or not to aggregate that with the other properties or not. But that is something to keep in mind if this election is permanent. So it is a big planning idea that you need to sit down with your CPA and talk about what is going to be aggregated and what is not going to be aggregated.
So let's now talk about the unadjusted basis of qualified property. I am sure that everyone on this call knows that if you're a high earner and you have real estate in your active trade or business, rental or otherwise, you typically need to have the 2.5% of the unadjusted basis of that property equal what amount?
So it has
40% of the net income,
right?
Right? And so if you have $1 million building, it cost you $1 million, you're still depreciating it, that's going to give you a $25,000 amount, which will enable you to write off up to
$25,000
in income.
Right.
Once you buy an asset and it is used in the trade or business, you have until it is completely depreciated, or 10 years, whichever is greater. So if you are able to write off certain components of a building using component depreciation, you can still include those items for up to 10 years. What else, Brandon, off the top of your head, do the new final regulations say about the determination of unadjusted basis?
One thing that's important here is that you're required to report this basis for each activity, and if it is not reported, then it's presumed to be zero. So make sure you have these items reported. We don't want that presumption to apply. And the other thing is that there's really a cliff here that can apply, and if you're relying upon this unadjusted basis, if your income's over the threshold, and the property is getting near the end of its depreciable life, you need to maybe think about acquiring new property to make sure you still have basis so you're eligible for the deduction. Because after 39 years, you could go from $2 million of basis that you're using all the way down to zero. That could dramatically change the tax consequences.
So you'll either have to start paying a lot of wages, because one formula is the percentage of wages. The second formula is a smaller percentage of wages and the 2.5% of qualified property. What about if you do a 1031 exchange?
Yeah, so if you do a 1031 exchange, the final regulations say that you are actually having a carryover basis of the relinquished property, so you don't get a new basis. Now, if you do pay a boot on the transaction, meaning extra cash, you are allowed to take that extra cash paid for the purchase of the property into account, and you'll be considered to have a new holding period for that excess cash that is paid. But one thing to think about here is, if you really need to have more basis, maybe work this away so you can not be subject to the 1031 exchange rules and actually just go ahead and pay the gain on the sale, so that way you can get new basis that would apply to maybe increase your Section 199A deduction going forward.
Very good. And I will just take you now to page 102. So we'll skip a few pages just to show you, first of all, there's a lot of things here for everybody to read, but a lot of it won't apply to you if you're not involved in anything other than real estate. But at page 102, we do mention the qualified property test. We lay it out pretty well. The hybrid test there at the bottom. And then we have, beginning at page 103, a number of Section 199A strategies and considerations. We are not going to go over all of these with you. As I mentioned, a lot of people are going to do better being treated as proprietorships on a Schedule C than as S corporations, even though it was different in the past. A lot of partnerships here at Section C on page 104 are structured with guaranteed payment arrangements. If your active trade or business invests in other entities and receives guaranteed payments based upon capital, they will not be able to deduct the income attributable to that. So there are a lot of real estate deals that are going to need to be restructured. Under Section D, if you sell a trade or business asset at a gain, and it is considered as ordinary income under what we call Section 1231, then you will get the 20% deduction. That can include real estate used in a trade or business that would be taxed as a capital gain, but I think you would still get the deduction, would you not? We'll have to look into that.
If it's taxed as a capital gain, I do not believe that you would get the deduction.
Okay, but if it's a 25% recapture, you would get the reduction. There are reasons that your clients will, or that you, if you're listening, will want to reduce your income so that you don't have to have the wage and qualified property requirements. On the other hand, you may decide that you would like to increase your income, but have a lot of that income put into a pension plan. And if you are in the real estate business and you can have people who were employees actually become legitimate independent contractors to save taxes, they may not have to be on your pension plan, but there are complicated rules called the affiliated service rules that handle that. The 1231 rules are here on page 108. And finally, there's a lot of marijuana farming going on out there now. That's on real estate. And as I think everyone involved with this knows, or maybe you forgot if you've been smoking it, but you can't deduct any business expenses relating to the sale of marijuana or marijuana products because it's illegal under the federal law. But we don't think that Section 199A is eliminated by that rule. So if you have $1 million of sales from your marijuana farm and $500,000 of expenses, your net income is still $1 million, but you might still qualify for the 20% deduction, so you'd pay tax on $800,000. So I think people are still hashing out exactly what they're going to do on the planning of the marijuana farms, but we've been seeing them in partnerships, C corporations, and S corporations. Finally, if you're not getting along with your spouse, there's probably some good reasons under Section 199 to get divorced. Maybe break the news to them this weekend that Section 199 has just changed the way you look at things, and you can give your spouse that $157,000 threshold, see if they'll be willing to settle for $157,000 a year of income from being a partner in the partnership. They'll get that 20% deduction, and they won't have to cohabitate with you anymore. So they may just go for it. Well, that is our half hour in 36 minutes. As I said before, we welcome your questions, comments, and suggestions. I wish I knew which button to push to get us all the way back to the beginning so that you can see our ugly faces. But if you do have any questions, any comments, any suggestions, please just send us an email. We learn a lot from the questions and appreciate the opportunity to present this. Do tell your friends and neighbors and even your enemies and possibly even your mother-in-laws to watch this webinar. They can email us and we'll give them instructions on where they can watch it. Have a fantastic, productive day, and thanks for everything you do for others.